All right, welcome back. This is Patrick Barlotta. I want to continue our discussion by focusing on the statement of cash flows. This will complete our set of covering the three main financial statements. First, we covered the balance sheet, then we covered the income statement. Now we're going to cover the statement of cash flows. So let's get into it. Before we do this, though, I think it's worth, for this one, probably even more so than the other financial statements, it's worth just backing up a bit and making sure we have just a general understanding of the mechanics. And I'll just offer this in the experience in teaching this across all levels, from undergrad to executive programs. It is fascinating how this is just by far the hardest area to master. I think one of the issues is cash flows give the appearance of simplicity, but they really are very complex and challenging. And two, it's an area that's really heavy in bookkeeping. And a lot of adjustments, actually, specifically the statement of cash flows operating section. And humans, at least the humans I've interacted with, we don't really naturally think in adjustments. It's just extra work. And so of all the statements, by far the hardest one to master, to kind of wrap our head around, is the statement of cash flows. It focuses on adjustments in the operating section. And as a result, it actually kind of moves away from the specifics of the business. Now, all the financial statements are hard, getting exposure to a bit of jargon, new terminology, et cetera. But the balance sheet and the income statement can be a little bit more accessible to most people only because they focus on the business conducted. So if you have a good understanding of the business, those are a little bit more natural. If you have, but I guess what would help you be really naturally good at the statement of cash flows would be a good understanding of mechanics and adjustments. But that's relatively rare. And if it's you, that's wonderful. But that's a relatively rare skill that we rarely see, in an MBA kind of classroom, but it exists. So I want to emphasize this. Put your time in here. It's worth it. Obviously, many of us talk about and use cash flows. There's a lot of misunderstandings, a lot of confusion. But if you're able to really understand how cash flows relate to the business itself and this translation we use to cash flows, I think you're going to have a great opportunity to really understand the pieces instead of just kind of mindlessly go through the mechanics. So this is not a full lesson on working out the statement of cash flows and understanding all of the complexity and nuances that will go well beyond the scope of this particular introduction. But I also thought it was useful to just have this slide up here to cover the roadmap for the mechanics that we're going to see. So one, use your own experiences. We've actually all lived this, but we may forget that temporarily as we're going through it. The statement of cash flows, these are, especially in the operating section, we're talking about adjustments. But the adjustments do have logic behind them, so it's worth checking that out. What's the logic behind the adjustments? Well, more of an asset, or if we buy more items, assets will have less cash. So more of an asset translates to less cash. We'll see it as a negative adjustment on the statement of cash flows. On the other side of that, and there's four of these that are worth kind of getting at, making sure we understand, two related to assets and two related to liabilities. If we sell assets, and by we, I mean all of us in our interactions, if we bought assets, right, we would be using cash and having more assets. So more inventory, more property, plant, and equipment, more of those things should translate to less cash. And that does translate to less cash on the statement of cash flows. There'll be negative adjustments. If we sell items, conversely, if we sell things, we would sell those assets, we would receive cash for the assets. And so less of an asset. So if inventory goes down, if property, plants, and equipment go down, we're actually going to see a positive adjustment on the statement of cash flows. Less of an asset, selling off of an asset translates to more cash. To be clear, I realize we're not actually always buying and selling. I'm using these two as a guide. Technically, all assets are going to work the same way. So less of an asset doesn't always literally mean we sold it. It does for inventory in most cases. But if we have less of an asset, that will translate to more cash. If we have buy more of an asset, so the asset goes up, that's going to translate to less cash. On the other side of the balance sheet, everything's going to be flipped, and it should be, because the balance sheet identity, assets equal liabilities plus equity. If we're moving in one direction with assets, we need to be moving on the other side of the equation, the opposite direction with liabilities. So if we don't pay for things yet, we're going to save cash in the current period. I realize that doesn't mean we're all going to save cash perpetually, but we're going to save cash in the current period. So more of a liability translates to more cash. If we have a bunch of bills, we didn't pay them yet, all else held equal, we have we've conserved cash or saved cash. It's not a direct inflow, but like bills we didn't pay yet is conserving or saving cash, all else held equal. And the other side of that, as we pay for things we owe, As we pay down liabilities, as we, as regular people, pay down our bills, we're going to spend cash. When you pay your utility bill, right, your liability, the utilities payable, goes away, and your cash goes down for the amount you pay. When you pay down any bill, right, the cash goes down and the bill is satisfied. Same for companies. As liabilities goes down, cash goes down. As liabilities go up, it's not literally an inflow, but it's like conserving cash. It works the other way. So the adjustment when liabilities go up is going to be translate to a positive adjustment on cash flows. When liabilities go down, when we pay down our bills, translate to lower cash that we have, less cash we have. All right. That actually applies to all three sections, but the hardest section is going to be the statement of cash flows operating section because it's all adjustments. Let's get into it now with Pepsi, and then I'll do it again with Chipotle. All right. So let me just get this there. With Pepsi, what do we have here? This is Pepsi's statement of cash flows. We've covered their income statement and their balance sheet for 12 months ended December 31st, 2020, 2021, and 2020. 2022, 2021, and 2020. The first half of this, which I didn't put in a box, is the statement of cash flows from operations. And we start with net income. You can see that right at the top. We start with net income right at the top. And then what are we doing there? As we go through that, everything on there, and I'm not going to cover all these. It gets pretty complex with real companies. There's so many transactions. But I want to be really clear about this. Everything is an adjustment to net income. So why is this challenging? These are not cash flows. The statement of cash flows operating section does not contain cash flows. It does not contain cash flows. It contains adjustments. The phrase I use when I talk about this is, if we called the statement what it would be the statement of convoluted adjustments to arrive at cash flows. I'm not marketing for a reason. That would never work. That's not, nice, sweet, simple, and everything else. So that wouldn't sell. But that's what it is. It's the statement of convoluted adjustments to arrive at cash flows. And I've asked this question consistently in class. The first time I ever cover statement of cash flows, I'll throw this up and I'll ask, which of these are cash flows? And you get a variety of answers. People pick out certain numbers. People say all of them, et cetera. And the answer is only the last line. The last line being net cash provided by operating activities. That's the only actual cash flow. So what is everything else here? It's an adjustment to arrive at cash provided by operating activities. Every single line between net income and the cash provided by operating activities is an adjustment. Let's go through some of these. We're not going to go through all of them because the complexity of this is kind of beyond the scope, but let's get a feel for a couple of these. First one is pretty common, depreciation and amortization. Why are they making an adjustment? I want to call it what it is, an adjustment for depreciation and amortization. The reason for that is all these adjustments, let me be clear, are bookkeeping adjustments. So the statement of cash flows is the most bookkeeping heavy component of financial statements. It's all about bookkeeping. It's not about representing the business. It's about bookkeeping, translating things to the cash account itself. So it's a bookkeeping focused statement. Depreciation and amortization, when that journal entry is recorded, we haven't even covered journal entries yet. We're not going to be credit decreasing cash in that split second when the journal entry is recorded. As a result of that, because in the bookkeeping sense, it's called non-cash. And that quite literally means when the journal entry is recorded, we're not actually paying out cash. In a debit and credit sense, and going a bit beyond the scope of this class right now, it's like we don't credit decrease cash when we record that expense. That doesn't mean there's no cash implications. That doesn't mean that there's not a corresponding cash flow. That doesn't mean we're not using up resources. It's purely bookkeeping. So what are we doing here in the top half-ish of the operating section? We're going to be adjusting out expenses like depreciation and amortization that in a bookkeeping sense did not credit decrease the cash account. We're going to adjust them out. We adjust them out by adding them back. So they decrease net income, we add them back, so the net effect is zero. That is with expenses or losses that don't involve an immediate bookkeeping decrease to the cash account. So any expense or loss is going to be adjusted out by adding it back. So those are items that decrease net income. We add them back so the net effect is zero. Why do we want the net effect to be zero? Because when we did the bookkeeping, we didn't decrease the cash account. So if we do the bookkeeping, we don't decrease the cash account. How much did cash go down? None. How much did net income go down? By whatever the amount. So in this case, for depreciation and amortization, it went down by $2.7 billion. If I leave it there, it would be down by 2.7. But because I didn't actually decreased the cash account by 2.7. I need to add that back. So the net effect on my cash provided by operating activities is zero. Right? We do these item by item so we can exclude things like tax effects, et cetera. That's actually not done line by line, but like each item on its own, that's what we're saying. So impairments and other charges, that would work the same way. The operating lease right of use asset amortization, that also works the same way. Share-based compensation expense works the same way. Restructuring and impairment charges works the same way. What do I mean by that? I'm not going to cover each of these, but each of them are items that decrease net income. But when the bookkeeping system recorded the entry, it didn't decrease the cash account. So as a result, we are going to add that back so that when the bookkeeping was done, there was no net effect on cash flows. These are all items that decrease net income, but the bookkeeping adjustment had no decrease to the cash account. We add back the amount of the expense to offset it so that the effect on cash is zero. All right, so those are the ones we're adding back. Expenses or losses that decrease net income, but when the bookkeeping system is processing entries, don't decrease the cash account. It actually goes the other way as well. So I'm going to jump up a bit here. That gain associated with the juice transaction. Well, a gain would actually be something that increased net income, but didn't involve an inflow of cash related to operating activities. So in this case, when we sell things, we're going to recognize that in the investing section, which I'll cover a bit later. But in this case, there's no effect we would say this is outside of our operating activities. Let me state that again because it's worth repeating. Even though this item, this gain, increased our net income, we are saying that it's not related to our core operations. As a result, we're going to adjust out the increase to net income. So the increase in net income was $3.3 billion. If we subtract 3.3, then we're going to have them offsetting. So gains that don't involve operating activities get removed by subtracting them out. Expenses where the bookkeeping system doesn't decrease cash get added back to remove them. So we're basically offsetting the effect on net income. Net income goes down, we add it back. Net income goes up like a gain, we subtract it out. That's the general idea. And that is all of those things from net income down to that last line, tax payments related to the Tax Cuts and Jobs Act. The complexity of each of these is actually quite big. And that's just because there's a lot of bookkeeping adjustments we need in this very bookkeeping focused statement. So, but they all work the same way. Without covering them all, I want to give the general idea. There are adjustments to offset the impact on net income where there's a disparity between what's going into net income and then like what the bookkeeping system did. When we're done that and work through those, we actually go to the next section. I'm going to call it the second half. I realize these are not exactly in half, but statements of cash flows have these two sections. It's like roughly the top half, roughly the bottom half, but I wouldn't expect that to be literally even amount of lines. There's no reason we should. But the second part of the operating section, we're still in the operating section, is where we reflect changes in operating assets and liabilities. They actually just say they are changing assets and liabilities. I would just want to make the note, change in operating assets and liabilities. It's not all assets and liabilities. They're going to go in the other sections. So it's going to be assets and liabilities related to our core business. Accounts receivable, inventories, prepaid expenses, accounts payable, income taxes payable, et cetera. These items, these are not the actual balances from the balance sheet. This is the change in the balance. But it's not even just the change in the balance. What it is the translation to cash flows of the change in the balance. So with that, I'm going to grab some of these and talk about them. This goes right back to the slide I started off this conversation with, the roadmap for mechanics. Inventories. The inventory line, the adjustment for inventories, and please get very comfortable calling these adjustments. I'm spending probably way more time on the statement of cash flows just because of the incredible confusion. And then that leads to so many big issues with valuation and forecasting, and so many decisions kind of are built off of a misunderstanding of the statement of cash flows that just gets bigger and bigger and bigger. Anyway, let's try to address it, right at the core. Let's get the fundamentals right before we do the fancy stuff. Inventories, it's an adjustment for inventories. What kind of adjustment? It's a negative adjustment. What does that mean? Well, if it's not inventory itself, it's the translation of cash. That means we have $1.1 billion less of cash related to inventories. So what would that be? Well, if I have more inventory, back to my first slide, I would have less cash. So what is this saying? It's not saying inventories went down. Absolutely not. It's saying the change in inventory translates to 1.1 billion less of cash. I'm using the 2022 numbers. The change in inventory translates to 1.1 billion less of cash. Well, how would that result? Inventory went up. So more inventory means less cash. In fiscal year 2022, less cash of $1.1 billion. More inventory, less cash. It's an adjustment. It's a translation of cash. I'm going to go to the other one because it works the opposite direction. Prepaid expenses and other current assets. That's another example of an asset account. And what are we saying there? Well, if that item actually is a positive adjustment, that means that something related to that asset translates to more cash. Well, what would that be? It can't be more of an asset. It would have to actually be less of an asset. A little bit more complex than inventory, but worth trying to work through. Prepaid expenses, I'll just call it that. If we use up prepaid expenses, but we didn't purchase an equivalent amount to replace the ones we used up, we would be conserving or saving cash. So that using up an asset, the asset going down without repurchasing or replacing it, actually translates to conserving cash. And so that positive adjustment, which makes sense, it's actually not that big in any of these years. It's just kind of a truing up in a bookkeeping sense. The positive adjustment there means that our prepaid expenses went down. We used them up. We didn't fully need to replace them in cash during the year. So when an asset goes down, it translates to more cash. When an asset goes up, like inventory, it translates to less cash. Let's jump to the other side. We have accounts payable and other current liabilities. What happened here? Something related to accounts payable translates to more cash. The adjustment is for more cash. So what do we have there? Well, that would be accounts payable going up. As we, the company, are able to have more liabilities, we're going to be saving or conserving cash. All right. Just let this sink in again. I think the best way to work on cash flows is just, unfortunately, massive amounts of repetition. It's so complex. It's counterintuitive. It's all about adjustments. But work through these. Try to work them out on your own, and just gain as much exposure as you can. If you ever have the chance to get practice with statement of cash flows, don't pass it up. We all need it. We need thousands times more than we think we need. So figure out what you think you need, multiply that by a large number, and that's probably accurate myself first and foremost. All right. So when liabilities go up, accounts payable, income taxes payable, really anything, that's going to translate in a cash flow sense to more cash because we're saving cash. Unfortunately for Pepsi, we don't have, actually can go back a little bit. Income taxes payable is a negative translation, but only in fiscal year 2022. So let me go to that one and talk about it. We didn't have any of these in the opposite direction in fiscal year 2022. So in fiscal year 2020, the adjustment for income taxes payable is a negative $159 million. What does that mean? Well, what would cause there to be a translation to less cash related to our income taxes payable? We paid taxes likely to the IRS this period. And if our income taxes payable goes down, that translates to less cash. So during fiscal year 2020, Pepsi paid an incremental amount compared to the beginning balance of income taxes payable of $159 million. So the income taxes payable liability went down, and that translates to less cash. That's the way this works. Let me recover the operating section. Definitely would still suggest more practice here. What do we have? In the operating section, it's a series of adjustments to arrive at cash provided by operating activities. The adjustments are always going to be more challenging simply because it's adjustments. They're not actual cash flows. And this is, again, a bookkeeping focused statement. It's still important because we care about how much cash do we have? The operating section is the most complex of all of these. And so what is the operating section? To recap some things here, the operating section is going to show us the cash that results from our core business, which generates net income, making bookkeeping adjustments for a variety of cash flows. What was the actual bookkeeping effect when we recorded those entries, and also adjusting for changes in operating assets and liabilities to arrive at, in that period, what is our cash flows from operating activities. All right. So with that in mind, we have this section of the statement of cash flows focuses on cash flows from operating activities. I want to just offer this as day-to-day operating activities. The reason why will be explained when we jump into the investing section. So it's not all of our operations. The statement of cash flows operating section is not actually a distinction between operating and non-operating. It is this section, this first part, cash from operations, is really cash from day-to-day operations. So one of the things I do when I teach this is just emphasize that. The difference between this section and the investing section, which I'll cover in one moment, is the length of like the frequency or the interval at which we engage in these cash flows, not really what they're focused on. The stuff in this section, we're trying to get like the recurring day-to-day kind of movements in cash flows. All right, operating section, challenging, adjustments, bookkeeping focused, got to work through these and focused on the day-to-day cash flows. Let's go to the investing section and the financing section. I just pulled those two together just to make this work. All right, jump into this one. What do we have here? All right, so this is the investing and financing section. To be clear, the statement of cash flows is presented with all three together. It just would be too much for one slide. Let's go through these. The investing section, I'm going to talk about what it is in relation to what I just did with the operating section. It is longer-term investments. Longer-term investments. So the difference between operating and investing is not where they spend the money or receive the money. It's the duration or the length of that. So what do we have here? We have movements related to longer term things. And what Pepsi mentions is capital spending, sales of property and equipment, acquisitions of companies, proceeds associated with the juice transaction, which we've seen a couple times, other divestitures. Think about that list right there. That's all like longer term stuff. They acquire, they divest, they engage in capital projects, they sell property, plant, and equipment. All that stuff is a part of their business. It's a part of their operations, but it's not a part of day-to-day operations. They're not doing this every day the same way they're selling inventory every day or they're making payroll very frequently. So that's the difference here. This is the duration. So this is the difference in the investing section is it's cash flows from longer term investments. I would recast the operating section as cash from day-to-day operations, and this one is cash flows from longer term investments. All right, let's just quickly cover some of these. Capital spending. That is the incremental amount of cash in the period that they spent on their capital projects, like purchasing factories or equipment or trucks or stuff like that. Sales of property, that's the opposite way. A big company like Pepsi is obviously buying more than it's selling, but it's selling pieces of property, plant, and equipment relatively frequently, $251 million in that 1 year. Acquisitions. Another way companies grow is not through just through their own expansion of property, plant, and equipment, but it's by acquiring other companies. So this is another form of capital expenditures, amounts of money they're spending to grow their business over longer horizons. The juice transaction works the same way. They actually sold it. That's why that's a positive adjustment. So if these are negative, it's when they spend cash. If these are positive, it's when they receive cash. So they receive cash from selling the juice transaction, from divestitures, and from selling assets. And they spend cash on capital spending and the acquisitions. That's their first half of the investing section. Not all companies do what Pepsi does, but I like what they did. They're also giving like two sections of their investing section. And the second section starts with the short-term investments by original maturity. What they're emphasizing here is these are outside of their core operations. These cash flows in the investing section, they're related to making financial investments. So like think of this as them buying stocks or bonds or CDs or stuff like that, treasury bills, et cetera. That's just that companies have excess cash on hand and they like us in our, you can have a brokerage account, a retirement portfolio, or moving that stuff around. Hey, I want to get a certain return. I want to get 5% return right now. I want to invest in this mutual fund, this ETF, et cetera. Think about that as the exact same thing with companies, right? They do that same thing that we do. Now, why is this in an investing section? Because it's not really like day to day. Pepsi is not a brokerage, but they still have investments. Like they still have cash they want to invest. And they invested there. So they've separated these out to get at, these are cash inflows and outflows related to financing, buying financial assets. If it's an outflow, it means they purchased a financial asset. Same as all of us. If you buy a mutual fund or a stock, if Pepsi or you or I were to buy Apple stock, we would spend cash and we would receive, the investment in Apple stock or the investment in the mutual fund. And so when they're making the investment in a financial asset, that's an outflow of cash. When they're selling it, so then after 10 years, whatever else, you feel like it's reached its peak, I don't know, whatever, you have a liquidity need or they have a liquidity need, they could sell the stocks they bought. They could sell the mutual funds. When they sell them, it's a inflow, a positive adjustment. When they're buying them, it's an outflow, a negative adjustment. All right. To be clear, these are not indicating gains or losses on their position. It's just the movement of cash, right? It's the bookkeeping piece of this, the movement of cash in and out of things. So negative, they spend; positive, they receive cash. Sorry, they spend cash; positive, they receive cash. That's our investing section. Cash from longer term investments. Let's finish off with the cash from financing activities for Pepsi. What would I call this one? Cash from external financing, right? It's not all of their financing, which is mostly from operations. It's the cash they're going to have from their external financing, which is effectively, or mostly, I should say, cash received or paid to debt holders or received or paid to equity holders as well. So they also have this kind of segregated in a useful way. First one, proceeds from issuance of long-term debt. And right next to that, I'm going to combine these two. They have payments of long-term debt. So proceeds from issuance of debt. When Pepsi issues debt, they're going to receive cash. It's a positive adjustment. And then they're going to have more debt on their balance sheet. But then when they pay their long-term debt, they're going to use cash, pay down their debt on their balance sheet, use up the cash there. So we see both directions there. Debt redemptions is basically a form of paying down debt. I'm not going to get into the specifics, but you can see both directions. One, when they issue debt, it's an inflow of cash. When they pay down debt, it's an outflow or a use of cash. Same thing with short-term borrowings, right? That's just changing the duration. And the financing section includes all external providers of financing, whether they're for 2 months or 3 months or 25 years. So they see the same movement. The proceeds is when they're issuing debt. The payments is when Pepsi is paying down its debt. And then they also have transactions with their shareholders. And so the cash dividends paid, that's when Pepsi is paying dividends to its shareholders. Share repurchases of common stock, that it would be when Pepsi is buying back its stock. So both of them are using cash. Those are effectively distributing cash back to the investors, in the shareholders of Pepsi. And then they have a much smaller inflow, which is that the proceeds from exercise of stock options, that they do have an opportunity when they're giving employees options to receive small amounts of cash. I want to really emphasize the small amounts of cash because every year the amount they're bringing in is very small and the amount they're repurchasing or paying in dividends is significantly large. That's expected for a company like Pepsi. That's not a weakness or strength thing. That's an expected result. That you're going to be more involved in returning capital to your providers of capital than you are in receiving it, but you can technically still have some incremental issuances as they have. So what do we have here overall? You have the inflows and outflows related to cash from external providers of capital. Two main forms: providers of debt capital, providers of equity capital. You can issue debt, that's an inflow. You can pay down debt, that's an outflow. Short or long term, it all works the same way. I appreciate they split these out. They actually should be doing that. Second, you can do the same thing with your equity holders, right? You don't have to make literal principal payments, but you can return capital to your equity holders by either paying dividends or by repurchasing shares. And so stable, established companies like Pepsi are going to be returning capital. On the other side, though, you can actually still issue shares. So earlier stage company might have more issuances than repayments, but Pepsi as a mature company is going to have more returning of capital to its investors and a small amount that they're bringing back in. That's the investing section. 3 sections, the statement of cash flows: operating, investing, financing. Each one is different, focusing on a different area of the business. To recap that, day-to-day operations, longer-term investments, and external providers of financing. The separation of those shows both the inflows and the outflows. So each line is important, as is the total of each section. Finally, the sections give us a different insight into the sources and uses in cash. And this is not full-blown analysis, just some very quick descriptive stuff. We'll do that later. But the challenge here with this is that you have to be thinking about the translation of cash flows. It's a very bookkeeping heavy statement more than the others. It's less about what the business did, but it's still essential, right? Your ability to stay in business is related to your ability to have sufficient cash from your day-to-day operations, redeploy that into what you need for your longer-term investments in the investing sections, and ultimately, or at least in the long run, return that capital to your providers of debt or equity, even if in the short run you have to bring in capital from your providers of debt or equity. So that's our 3 sections. It's a great complement to the other 2 statements. Probably, definitely the hardest one to use, definitely the most bookkeeping of them all, adjustments and stuff like that, but still very informative to complete the set to make sure we understand all the angles of our business. We don't just want to understand what they did in terms of the core business on the income statement. We also want to understand, okay, but how did that translate to cash flow? An incrementally useful perspective here. Definitely more to cover here. Complex statement, really fascinating one. And I like the way that it complements the others, but that's it for right now. One more down, 10,000 more to go. Take care.